and growth. This will help create the conditions that will allow businesses to create better paying jobs, more financial security for our families, and more income to pay for world-class education and health services. This will also position us well to withstand future challenges. Unlocking those benefits requires a focus on our business tax settings to ensure growth, encouragement of private enterprise, and the kind of investment which supports improved productivity, which brings me to Investment Boost. We designed Investment Boost to counter the problem of low capital intensity amongst New Zealand businesses, that is, the low investment in machinery, tools and technology. More capital means more and higher productivity and wages and a better standard of living. The increase in the New Zealand capital intensity has slowed over time from 1.9% between 1997 and 2008 to 0.7% between 2012 and 2023. Investment Boost will help overcome this by allowing businesses to immediately deduct 20% of the cost of qualifying assets, reducing their tax bill in the year of purchase, or create or construct the asset. This is targeted support to those businesses who want to grow and want to achieve and invest in assets to improve their productivity and become more competitive. It's an investment in a stronger economy which benefits us all. The budget bill also introduced changes to KiwiSaver designed to help increase the balances of New Zealanders' KiwiSaver accounts at retirement or for saving for their first home. The default employer and employee contribution rates will rise from the current 3% of salary to 3.5% from 1st of April 26, followed by a further increase to 4% beginning 1st of April 2028. We also want people to get into savings for their retirement or their first home sooner, and so we've extended the eligibility to those individuals who are 16 and 17 years old. Budget 25 ensures that the scheme remains affordable and sustainable by reducing better targeting of the KiwiSaver government contribution. The government is halving its annual KiwiSaver contribution to 25 cents for each dollar of member contribution. In addition, the government contribution will no longer be paid to individuals with an annual taxable income over $180,000. We made these changes after weighing up the value of maintaining the level of government contribution. Firstly, it was an untargeted payment. For the financial year ended 30th of June 2024, 52% of government expenditure on the government contribution was received by those earning more than $70,000 per annum. There is little evidence that this subsidy is incentivising people to increase the amount they are putting aside for retirement. And the other part of our approach is managing the tax system is to ensure that we collect revenue we need to fund services and functions. Budget 25 provides new permanent funding of $35 million per annum for IRD to carry out tax compliance and collection activities. It also provides a permanent continuation of funding of $26.5 million per annum provided in Budget 2022 due to cease in June 2025. The continuation of this time-limited funding from Budget 2022 of $26.5 per annum is expected to raise $816 million over the forecast period, and this is a return on investment of $8 to 1 over the forecast period. By anyone's measure, this is good investment. As the Commissioner may tell you, there are early signs that IRD is on track to meet and exceed the forecasted additional revenue and cash collections from Budget 2024 funding. All in all, the measures I have discussed today illustrate careful management of the tax system aimed at fostering economic growth and providing targeted support for those who need it, while retaining tight control over the government purse. With that, Mr. Chair, I'll welcome questions.
Thank you very much, Minister. And just to note to members that we have got till 3:45 if we need that long with the Minister and his senior team here of officials. But I'll start with the Revenue Lead for Labour, the Honourable Dr. Deborah Russell.
Thank you, Mr. Chair. One very quick primary and then another primary on the partial expenses. So the quick one from Inland Revenue Officials, the long-term insights briefing. When can we expect to see that?
Thanks for the question from the member. Obviously, that's an important process that we do on a regular basis. Currently, ministers are seeing the first versions of those, and those will be coming out in due course this year.
How long do we think? I mean, in due course, but 2 months, 3 months?
We're expecting to be able to put that out within the next month, probably.
Right,
Yeah.
good, thank you.
The draft. Yeah.
Okay, that's really helpful. I appreciate it. Thanks, that's a process that we work through. And this is now for the Minister, the partial expensing. I think both Barb and I are on record as saying it's probably a good move economically to do something in this space. What we're interested in is trying to track the partial expensing and how much it costs. So can you talk me through how you're going to track how much firms are claiming on partial expensing through and then revenue systems, or what you put in place there?
Yeah, well, first and foremost, the investment boost policy by this government is a policy at its heart, a simplistic intervention. It is uncapped and is deliberately so in order to ensure that there is a simplicity of application to achieve its broader outcomes. The question that you're asking in regards to how will IRD and the broader system be able to track the progress in terms of uptake of that. The Minister of Finance was equally questioned on this, I understand, consistently as well, and that IRD will be having a time series of data which will help inform some of the signals. Obviously, there is as you will be aware, a lag in the context of the activity flow through in terms of when that will be seen in terms of the broader GDP economic context. But I guess what is anecdotal but positive is the feedback that we have received overwhelmingly across the board from New Zealand business of the support for such a mechanism and the context in which its application is very much broad-based and will be applied to all aspects of our economy, which obviously has a significant benefits across the board.
Yeah, I agree with all that. We'll just have to wait and see. It's going to be, we'll discuss that with Treasury officials too. It's going to be hard to pick apart. What I want to understand from officials is when we can start to see how we're going to find firms are actually using it. And I'm assuming, so it starts from March 22nd, so the earliest balance dates that could claim it would be 30 June, realistically. So what about December, November, December, January, depending on when they file? What's your expectation?
Yeah, well, it's obviously going to be dependent on as and when the entities are making a subsequent, tax filing in regards to their financial position and when they're claiming that such deductions in order to flow through of that tax benefit on their taxable income. That will vary depending on the businesses, but in terms of the context of timeline, we would expect that to start flowing through. In terms of being able to have that information, obviously the activity started to flow from the 22nd of May, but the actual flow through of that information in terms of seeing what that looks like in terms of size and scale is likely when those tax returns begin to be filed, which is very dependent on the nature of the business.
Yeah. I just want to make sure I've got the policy right. So we can claim the 20% partial expensing straight away, and in addition to that, claim whatever depreciation of the remaining 80% is available. Right, okay, good. And I'll be on separate lines. One of the things I want to know is to what extent, Minister, some work was done around the deadweight cost of this policy in terms of it providing an extra upfront cash flow advantage to firms that would have engaged in purchasing assets anyway.
Yeah, I mean, in the context of just to clarify your point, because I think it is important for those that are watching, the 20% depreciation, there's a large number of people watching in the tax community. This is the most exciting thing that's going on today at this time for those in the tax community.
This is a blockbuster in the tax community.
That is a compliment to all members of this committee, not just those that are answering the questions. So, I give the example of solar panels, which is obviously close to my heart as Energy Minister, but the depreciation rate on those is in the region of 16%. Hypothetically, with the investment boost scenario, in addition to the 16% deduction depreciation that you can take for a solar panel, you will in addition get a further 20% in year one, taking that through to 36%, and then the balance remaining, and that will be depreciated over the life of the asset. So it does have a material implication in the context of bringing forward that degree of tax incentive in terms of year one. I think where that's amplified and is interesting is the context of much longer dated assets, or longer lifed assets. Hypothetically, if you're in the business of building a new hydro dam, not saying that is the case, but if you were in that market, those are obviously long dated assets. But again, this policy is deliberate that you would still be able to get a 20% deduction in addition to that straight up. Your question around deadweight cost in the context of what would have occurred irrespective of whether this policy was here or not is consideration in terms of more broader economic. I'm happy to ask either of the team to provide a little bit more clarity, but it is a difficult area to be able to quantify realistically. You're trying to make assumptions in terms of what activities businesses would or would not take in a future point, and obviously that, as you would appreciate, is complex. What we do know is that the reality of having an improved benefit of cash flow, being able to bring forward that benefit as a result of investment boost versus the status quo of not having it is seen as a positive reflection. And I can only feedback anecdotal feedback, and maybe other members around the table would have potentially had other feedback across party lines, that actually many businesses who were potentially considering an investment decision, this as a result may in some cases have brought it over the threshold line for them to accelerate that decision. And in that context, it's a positive move for our economy.
So was there modelling done on the deadweight cost, or?
So most of the modelling that we did was on the impact that it would have on GDP and wages going forward, and we modelled that. But the point you're making, which is, would there be investments that would have happened anyway that that would benefit from the investment boost? Yes, there will be. To try and address that, or to try and only target the investments that otherwise wouldn't have happened, would have made the rules a lot more complicated and probably not. Actually,
I don't see how it could have been sensibly done, but that's why I'm still interested in the deadweight cost, because there is a cost to it.
We didn't attempt to try and model that. Yeah.
Okay. So I get the anecdotal stuff, Minister, because I've been hearing it too, but I've been hearing people who said, "Oh, great, I can replace my ute." And so, it brings the expenditure forward, but it just changes one asset, an older asset for a newer asset. So to me, that doesn't necessarily give the productivity boost unless you can get somewhere a tiny bit faster.
Look, I think we covered this in the committee of the whole during the tax bill phase of the inquiry, where the exact question was asked by a member, and I gave a context of the reality that technology has advanced in the context of plant and equipment, and actually with more advanced technology brings productivity and cost savings obligation. I don't think that you need to be a rocket scientist to work that out, but machinery is more efficient in the context of operating costs, hypothetically, than what it was 10 or 15 years ago, and as a result, more efficient. Vehicles obviously use less inputs, and less inputs means lower cost to run and more productivity. So I think there is a clear understanding that what we deliberately did in the context of the scope of this bill was not to constrain it in terms of what was in and what was out. And I think there have been some questions, obviously, in regards to inclusion of commercial property and other elements. I mean, the simple reality is that any of that capital investment has the propensity to drive and aid economic growth within our economy, and having more efficient and newer capital in the context of business drives that efficiency and economic aspect. We have as we all know, we have a major productivity challenge in this country. There's no silver bullet to dealing with that aspect, but one thing that we have assessed that we can do tangibly to play a part in order to improve that productivity is through this intervention. And we'll watch in the context of the way in which it derives outcomes. But it's one of the things that I'm very proud of being able to implement that in the context of the broader opportunities and challenges we have within our economy.
So I think on an ongoing basis, we're going to want to see just some data as it becomes available as to whether it is being taken up and things like that. We'll probably ask about it every time we see you guys. Sorry.
Yeah.
But one of the concerns we had in that context, and didn't really get an answer, I'm sorry, at the stage, but I guess we're all operating at full tilt at that stage, is just around the uncapped nature of this. And we just want to understand whether IR or Treasury did any modelling of the extent to which the costs could if there's an upside risk to the costs blowing out. I guess the worry if it's underspent is where we're not getting the investment, the increase in investment that we wanted. But what about if the costs blow out? Did you do any work on that? Or
Yeah, I'll let the officials comment in regards to the work we've undertaken. But again, I'll go back to the principles in which the policy was constructed. It was deliberately constructed in order to ensure that it was as simplistic as possible in order to get the broadest range of benefit for the widest number of businesses within our country. I make no apology that our government are relentlessly focused on economic growth. And actually, I have no cap, and nor do we want to put in place a policy that it caps economic growth potential as a result of that. But in the context of the modelling done with it, I'm happy.
So I mean, like any tax policy, we essentially made our best estimate of what we thought it would cost. There is always going to be a risk around it, but in conjunction with the Treasury, we confirmed what we thought the underlying sort of set of assumptions were. So it's our best guess at the midpoint. Will we have it wrong? Probably. Will it be higher or lower? I don't know.
Yeah.
Yeah.
Okay.
Okay.
Sorry, David, you were going to say something?
I was just going to say too that, I mean, the way we would think about the cap too is if you were worried that by not capping it, the costs would be too high. The way we would think about that is not to impose a cap, but to actually reduce the rate. So go from 20 to 15 or that would be a better result than artificially coming up with a cap.
Cap on the appropriation.
Just one.
Okay, we've just got one up from Dr. Woods, and then we're going to go to Chloe Swabber.
So adjusting the rate would be one way. Another way would be targeting it. Has any work been done on potentially targeting it? So, for example, we're not giving the subsidy to someone coming in with an oil rig.
So in terms of the policy design, the way in which it's been passed through in the legislation is obviously the scope in which we believe is the most appropriate structuring of that intervention in the context of scenarios around targeting, consideration around what that and what implication that would have, was thought through in the broader context. But again, I go back to the point of where we landed as a government is that simplicity and broad-based approach in terms of economic benefit was seen to, in effect, trump any other way in which you would structure that design. I think the reality is that one of the challenges in the context of, when government starts to pick winners or losers in terms of who's in or who's out, is the unintended consequences of that type of intervention, and acknowledging that, not all industries operate in complete silos or isolations of other industries or other participants within the New Zealand economy. We want all New Zealanders to be able to benefit, all working New Zealanders who work for businesses across all sectors to be able to benefit from this intervention, not in effect target certain workers or certain businesses because of a view of one over the other, deliberately broad-based simplistic policy.
So just to confirm, lowering the rate would be the preferred option over that.
So what you heard from the advice on my left is this the context in which, from an IRD modelling point of view, was one scenario that you could do. But that is not something the government considered in the context of reducing the rate.
Okay, I'm going to go to the Greens co-leader, Chloe Swabber.
To be clear, you would consider this policy a success if a multinational corporation came here, took advantage of it and expanded fossil fuel extraction in this country? Look,
what I consider a success is the New Zealand economy growing, and the mechanisms in which we've put in place to enable that through investment boost is one mechanism. There's obviously a range of ways in which we're going to achieve our broader ambitions, but I'm very, very comfortable that policy that we've put in place is going to be a fundamental and play a fundamental role in terms of driving economic growth. I appreciate there will be areas of industry or sectors that we may disagree on, and whether that is good or bad in the context of the New Zealand economy, and that's politics. I get that, but in the context of a broad-based, untargeted and simplistic policy to drive economic growth, I think this is an excellent vehicle.
I mean, it's not just a political discussion, it is indeed one that has real fiscal risks associated to it. For example, increasing our climate changing emissions is recognised as a substantive fiscal risk in DFU, but nonetheless. Did you commission any advice whatsoever on the extent to which the benefits of this policy may be captured by offshore players versus those domestically?
So just on your first point in acknowledging fiscal risk, I think the reality is with every fiscal risk is also fiscal opportunity. And I think we have to ensure that, we are reflective of the fact that, yes, we are operating in risk and benefit environment, but also, again, in terms of the challenges that we have as a broader economy, we need to grow our economy in order to pay for the public services that we require. And economic growth is positive. There are fiscal risks, and again, I don't think we're going to necessarily agree on all of that here. Your point around the second part of the question in the context of our broader modelling, I'm happy if the team want to provide a bit of context around it.
So on the broader modelling, we stuck to trying to work out the impact this would have on GDP and wages over the next 20 years. So that was the focus of the modelling. The modelling didn't focus on whether or not certain areas were carved out.
Okay. I mean, I guess just to clarify the point that you made in the start of your answer, Minister, you do not see at all the difference between the return on an investment, $1 invested in fossil fuel extraction and exploitation, or $1 invested in solar panels or renewable energy. Is that what you're telling the committee?
In the context of the role of Minister of Revenue, my focus is ensuring that the tax policy that we implement enables us to achieve the outcome, which is economic growth, through the lowest cost means and the lowest compliance cost on the New Zealand taxpayer. The policy intervention is deliberately broad-based, as we've discussed on multiple occasions, and that is because that is consistent with government policy. I'm very comfortable with the way in which the policy is designed, that it has the ability and will deliver the outcomes that is what it is intended to do so in the most efficient manner. And I think that's the expectation of the New Zealand taxpayer on government, that as and where we're going to undertake interventions, that we're doing so in a manner in which protects that we're spending their money, not ours.
And those considerations seem to be happening in exclusion of the considerations of the vast swathe of evidence about the impacts that climate change will have on our potential to grow.
I don't think anything's in isolation of anything else. I think the reality is that, these factors are part of the broader system in which we are operating within, and that every action has an equal and opposite reaction in the context of implication, and I think that's what we refer to in terms of risks and benefits. But this isn't a sort of one size fits all or black or white state of affairs. We need to drive, and we are intent on driving economic growth. We've got a vehicle in order to play its part to achieve that. But in addition to that, while not in the scope of this, we obviously have other mechanisms and actions and pathways underway to deal with such things as emissions reduction through our climate portfolio.
Which you're being sued over. But nonetheless, you made the point in your introductory remarks a lot about the idea of targeted types of investment. And this is obviously also rhetoric that's reflected from the Minister of Finance and the likes of social investment approaches and otherwise. Why did you not look at a more discrete or targeted package when it came to investment boost, looking at similar policy frameworks that exist overseas that, for example, are targeted more on small to medium enterprises? And, for example, in Canada, where I understand that there's specific benefit for those who are investing in renewable energy.
Yeah, I can only repeat myself in the context that the policy and assessment of the design of the policy was deliberately to ensure that it had broad-based effect and impact. I think when we look at some of the areas which are really positive, I used the example of solar panels, for example, in terms of the upfront tax subsidy in effect on that, which is a really important aspect in terms of decarbonisation as we electrify our economy. Any energy generation asset construction in this country is eligible for this policy, anything and everything in that context. And so, in terms of putting the money where our mouth is, and putting in place mechanisms that make it easier for that investment to occur. The proof is in the pudding in which this government has implemented, and that will, in its effect, alongside other interventions, play its part to achieve other social and environmental outcomes in addition to the fiscal outcomes, which is around economic growth. And I think, in the context of that, the market will determine where it invests its capital and what areas it will do so. And we already know that the market has a very keen awareness of the importance of balancing out, fiscal, cultural, and social considerations around investment. And that's as the market should do.
So for all intents and purposes, it was effectively a political decision on scoping, which sees all growth as good growth and doesn't discriminate between potential growth in our climate changing emissions, which in turn can dampen future economic growth.
Investment boost is a deliberate government decision to achieve the outcome, which is increasing economic growth for this country.
Okay, we're going to go to Todd Stevens.
Yeah, maybe it's just a follow-up, Minister and officials. Obviously, as you've outlined, investment boost is deliberately pretty straightforward and simple. Would there be economic and fiscal risks of designing a more complicated system where only some industries could access this, this tax deduction? Or
about your changes to benefits?
So what would be? Do you think there could be some downsides for making it a very complicated system?
Well, obviously, at a generic level, more complexity drives more cost, and that is very much the case within the broader tax system. I think one of the advantages of the New Zealand tax system in terms of low rate, broad base, and the mechanisms of revenue collection through PAYE and GST, fundamentally in terms of share of revenue collection, is in particular a highly efficient mechanism in order to collect revenue. There is a multitude of examples around the world of other types of taxes, but in the spectrum in terms of how do you collect the revenue you need in order to fund the public services that you deliver, the principle in which this government operates and our system operates is we do so through the lowest cost means in order to achieve that outcome. And I think what that means is that, you can only spend $1 once, and in the context of that dollar being available to, in effect, for businesses to invest in producing and creating value, employing people, doing all of those positive aspects to drive our economy. I mean, we'd far rather than investing that dollar to create value for future generations and using that to pay for compliance costs, which has no value to the broader economy. That's in effect a sunk cost to the economy. So I don't mean for this to be a basic economic lesson, and I know it isn't, but I think, just to convey when we're thinking about how we deliver, we actually take a pretty simplistic view around this, cost, benefit, how do we achieve outcome and execute that. And again, I'm very proud of the way in which this government has been, focused. What are the actions that will deliver the outcomes? And then relentlessly targeting that.
It's great.
Chloe Swellbrook's supplementary.
That answer stands in stark contrast to the complexity with which you designed the Family Boost policy. The last time that you were in front of us for Scrutiny Week, you told us that you were modelling based on 100% uptake, and we on the opposition were making it clear that based on the barriers to actually access that and the know-how necessary, that we weren't going to see that in practice. So can you tell us how many New Zealanders of the 100%, of those who are eligible are currently accessing Family Boost?
So in the context of where we are in terms of the uptake of Family Boost, that's something that is regularly reported on to me as a Minister of Revenue. I'm happy if officials correct me, but I think in the region of around 69% of eligible individuals have in effect taken up that at the latest numbers that I've seen. And the reality is that is steadily increasing. I think on public record, the Minister of Finance has made comments clear in the context that she has ambition in terms of ensuring that we do get the coverage equivalent with what is originally announced in the Contest Act policy, and that work is underway in terms of how best to achieve that. But I think going back, and for those that have an understanding of how the system works in terms of making estimates in regards to the broader numbers, we're not always dealing with perfect information, and I back my IRD team to make the best decisions they can with the information available. And
I'm not critiquing officials, I'm critiquing policy design.
They've absolutely done as good as what they could have done under the circumstance.
But just to be crystal clear on that, the point that I was making is that you earlier were talking about how it's important to have as broad and as accessible an approach as possible when it comes to investment boost because of the complexity which could create barriers to people accessing that benefit. But then you apply a totally different logic and rationale to Family Boost.
No, I don't. I mean, I think the reality is that you're comparing a scenario of status quo without Family Boost to having Family Boost. And I appreciate that members on my am I right, do not support Family Boost and do not support giving payments to families to help
That's
with
not
ECE.
true. That's
things,
not true.
which in
No,
effect what
actually
Family
stick to the
Boost is.
facts.
We can talk about the green
we won't-
budget if
we
you'd
won't-
like,
okay,
Minister.
I won't get into the
about
politics
ECE
on
20
that,
hours.
but in the context of
Okay,
the
hold up.
mechanism we've put in place, we
That's
wanted
not
to
okay,
deliver the outcomes
Chair.
in the fastest mechanism possible in order to get that benefit to New Zealand families in a way in which got them that benefit.
I think
we
the
are
facts tell a
achieving
different story.
that,
Okay.
and, you can sort of argue on the edges, but the situation, if you're a family receiving Family Boost now, is a significantly more beneficial position than a status quo position where you did not have Family Boost. And the
Not
reality is,
increasing
you
costs.
can talk to the cows come home around what you may or may not have done, but the reality is when we came in here, there wasn't a mechanism to deal with that. We have put that in place, and now New Zealand benefits are flowing to those New Zealand
Swallowed by
Right,
price
thank you,
gouging.
thank you, Minister. I'm going to go to our Deputy Chair, Ryan Hamilton, and then I'm going to go to the Honourable Barbara Edmonds. Ryan.
Thanks, Chair. Thanks, Minister. Welcome. I just want to press into compliance funding and a few subs if I could, Chair. But obviously, Minister, the government's invested additional funds into compliance funding. So just wanting to know what gave you the confidence to do that? What are you seeing and what do you expect to see over the next coming 12 and forecast period, 12 months?
Yeah, thank the member for the question. I think what was one aspect that surprised me when I came in is the context of the scale of tax debt that was owed to the Crown and the propensity of the growth of that debt, particularly over the preceding period. One of the challenges, obviously, in the fiscal environment is that collection of that debt avoids the need for me or the government to be able to borrow that debt, of which we're paying an interest cost, and there's a reasonably significant cost of interest in terms of the broader Crown P&L now than what it was in the past. So collection of that debt is critically important. It also goes to the heart of what I think New Zealanders expect from their tax system is a fair system, in the context that the vast majority of New Zealanders comply with their tax obligations and do what they should do. But there is a very small number of people that deliberately undertake behaviours to avoid and or evade paying tax. And those individuals, should be under the very clear view that is not the responsibilities that they have as New Zealand citizens, and that the IRD will respond in a way. So the compliance funding provides tools and mechanisms and resourcing to the department to execute that activity. I think also importantly, it also includes the propensity to try and ensure that we prevent as many people as possible from getting into a debt situation, and there are genuine cases around that. So it's not all at the ones that are rorting the system, and a very small number of people, including organised crime and other aspects, but there is a full spectrum in that lead up. The most efficient mechanism in terms of managing debt is to ensure that someone doesn't get into debt in the first place. And IRD are very, very experienced and active in that area. And what we as a government have recognised is that they need additional support and funding in order to make sure that we've got a whole end-to-end process around that. What I noted in my opening remarks is the return on investment on compliance activities is in the region as it ramps up from $4 return for every $1 of spend up to around $8. And I tell you what, if you compare any revenue agency and department in the world, the two gentlemen and the teams that they lead one of the most efficient revenue operations on the globe. And we should be very, very proud of our IRD capability. It is best in class. And the fact that we're helping support increase that area of what is bread and butter for a tax department, I think is positive. And actually, more importantly, it's positive to the 99% of hardworking Kiwis that comply with their obligations. And as a result of that, our debt level, we can manage that in a more appropriate manner. Ideally, at some point, have a downward trajectory in terms of overarching debt. But that's work in progress, and it's still early days. But I think the feedback we've seen already anecdotally in terms of the data that the department have had around their success in this space gave government confidence to continue that investment over the longer term.
Thank you for that answer. And what specific areas are you investing the compliance funding into? And is there any particular areas you're getting more bang for buck or better return or margin?
So as the Minister said, we do put the investment across the whole spectrum. So we're doing, it's as much about encouraging more people to file on time, pay on time. And we already get about 92% by value that pay by the due date. And that rises to 98% within 6 months. So that's really good. And we want to continue to encourage that. Looking forward, there are areas of particular focus. You may have seen this morning we put out a press release around the horticulture industry, for example. So there are some industries which show signs where there are high transactions, horticulture, hospitality. We've been doing unannounced visits to vape and liquor stores. We've got a focus on property. We raised about 155 million looking into the area of property speculators, property developers. So there are a number of areas where we are looking to put that effort. And so far, certainly to date, we've seen a very positive dollar return on that. So it does suggest to us that there is still some room to move. We will continue to put effort into trying to encourage people through voluntary declarations and to come and talk to us to bring them into the fold from being out in that hidden economy. But what the funding does is it gives us the ability to reach out into those communities much more actively.
Thank you.
Just a sup from me, how are we going with the small business COVID loans and the repayment of those?
In terms of the COVID loans, we put out, it was $2.3 billion worth of loans issued in total. 1.5 billion of that has been repaid. So there's currently about 880 million that is owed. Of that, we've got about 226 million which is in default, and that currently sits with 13,000 entities, and so we will be following those up. We already have, we've got, people would have seen, we've taken a number of prosecutions in that space. We currently have 20 prosecutions before the courts in that space.
Okay, good work.
I guess just in the context of the list, there's about 15 different categories or subcategories of debt when you look at that number. And the line item that you've just referenced is one of those: GST, PAYE, student loan, etc. The way in which the department is in effect targeting this is to ensure that no matter where you sit in the hierarchy of the tax system, the expectation of fairness and paying your way is the same. So if you're an independent sole trader or you're a large-scale multinational, yes, the numbers may be bigger, but fairness exists across the spectrum of the tax system. And I think that's really, really important because, that concept of fairness does exist no matter where you sit in the system, and ensuring that, where people can see that there are people that are, in effect, not doing what they should do and not complying, sets a behaviour and an expectation that isn't fair. And as a government, we have zero tolerance for that. And the IRD are working their way through that. They are very thoughtful around hardship and other challenges in terms of real issues in terms of why that is what it is. But on the flip side, they're also highly experienced at identifying individuals that are deliberately trying to evade. I think about the broader organised crime and that hidden economy portion. One of the best ways that we can deal with the underlying challenges that are social issues as well in our context is ensure that the mechanisms of money flow are dealt with as well. And so the IRD are doing some great work, working in addition with police and customs as joint agencies to deal with some real tough and difficult problems that we have inherited.
And what about that long-standing defaulting student loan debt, Mr. Mercy? How's that looking on the top line numbers?
Yeah, look, again, that's a challenging area. We had a target this year of bringing in 189 million of overseas-based student loan borrowers. We have exceeded that target. I think this year we're at about 220, 230 million. But it is a very challenging area. We're putting most of our focus into Australia, which is obviously both the biggest market for our overseas-based borrowers and the UK. We've done everything from working with the ATO and DIA to try and get updated contact details. We have debt collection agencies that are helping us identify and contact these individuals. And we have taken legal action in some of those jurisdictions. Obviously, that gets pretty expensive and pretty hard. But for some of those who are wanting to return to New Zealand and who have been particularly recalcitrant in in engaging with us. We do have the ability when they come to New Zealand, we try and contact them, and on occasion we will stop them at the border and have a conversation about whether they would like to set up repayments before they leave.
Very good. Okay.
Can I
we
just
Yep.
state though,
Minister.
and we talk about the ones that aren't, but let's just again go back that, you know, over, I think in the region of 97% of New Zealand-based student loan borrowers are completely complying with their obligations. You know, students in the vast majority, and a very small number, are not in a New Zealand context. And for those, you know, we acknowledge that, and you're doing what you're doing. But what they also need to know is that simply by, you know, skipping the country, you know, we will find you. And that mechanism as a department in the context of that is that no one gets a free lunch. And I just want to acknowledge the people that are and do comply with the system. That is the vast majority of New Zealanders. And, you know, that's great. And that's what people should do in terms of roles and expectations.
Okay, no, that's clear, crystal clear. I'm going to go to the Honourable Dr. Russell.
On this,
And you're next.
I see this increased, continued funding and increased funding around compliance activities. The trouble is we spent over $1 billion on a very fancy new inland revenue information system, which we all know was needed. But along the way, we were repeatedly told by IR officials that the snazzy, you know, all bells and whistles new system and the clever algorithms in it meant that we didn't need to have as many investigator staff. What's changed? You know, it just seems to me that actually during the time we were questioning as to whether this was really going to be the case, it just feels a little bit like a quick carpet pull.
Just that, I mean, in the context of my letter of expectation to the department as coming in as Revenue Minister, one of the clear areas that I noted to the department is to maximise the use of technology in order to execute, you know, the most efficient tax system in the world. And that is very much the focus and expectation that I have with the department, and the department are working very hard and diligently in that context, including, you know, what other options are available to us in order to broader achieve that outcome. In regards to the system components, Peter will give you a bit of an update on as and where we are on that, but it is an area of priority for this government.
And we're doing a number of things. We are able to do a number of things now that we couldn't do before we had the new system. So, for example, we talk about the $1.4 billion worth of revenue that we have found. 130 million of that was actually found by the algorithm, the new algorithms we can run in our system that identify people who are trying to receive a refund who shouldn't. So it's all automatic and it involves very little human oversight. We have a human who double checks that the machine's spitting out the right ones. The other thing it's enabling us to do is to much better target those parties that we do decide to audit or investigate. So, for example, our ability to consume information and use it has increased phenomenally. We now get information on all property transactions. So we can now go to someone who holds a tax debt and have a conversation with them that says, you've indicated to us you don't have the money to pay a tax debt, but we have information that shows you own a second house or whatever it might be. Therefore, we welcome the opportunity to hear from you. So we have information there. We have information on FPOS transactions and so on. So what the machine has done, it certainly has automated a number of areas, and it allows us to much better target so that we're getting a better return when we do go out and look.
That's lovely, Peter, and I completely agree, but it wasn't quite the point I was making, was that over the years that I've been in Parliament, we've known about the decreasing numbers of inland revenue staffers, and we knew that investigative staff were being redeployed and so on. And part of the reasons that were given, I'd have to go and dig back through transcripts and things to find, but I genuinely remember being told that the new system meant that we simply wouldn't need investigators and the like, and yet now they are being hired back. And I take the minister's point. This is all good stuff. It just feels as though what we were told previous years perhaps may not have quite been the case.
I think my response to that is I think the system has delivered the gains we were looking for, but the opportunity still exists for more, for us to push further into that hidden economy. The one thing we don't have a good sense for is what its size is. At the moment, the only thing we can really say is by looking at the returns, are we getting close to a point of diminishing returns? And the answer is no. So I think we are getting greater comfort and confidence in the money we're bringing in. It's more than we had before, but the opportunity, there are still parts of our economy out there that are working in the hidden economy, and we are getting a sufficient return that warrants further investment.
Okay, thank you.
Okay, we've got some subs here.
Yeah, just to your earlier answer, Minister, that was some tough talk about tax fairness. How is it fair that people with an average wealth of $276 million are paying half the effective tax rate of our firefighters and our nurses and our average New Zealander, as IRB research bore out a few years ago?
Well, I think the broader challenge in the context of the New Zealand tax system is that in terms of what you'd refer to as net taxpayers. So this is how many individuals in New Zealand are paying more tax than the benefits in which they receive from the government. That number is 50%. So 1 in 2 New Zealanders is paying more tax than what they receive in benefits or support from government. And I think it is a broader structural challenge that is in part goes to the heart in terms of where we're at. We talk about needing to be a more productive economy. We need to ensure that everyone is able to benefit and contribute, their portion. But the reality of where we are starting from is, 1 in 2 people are paying the tax, contributing to the public services in which we all expect and deserve. And I think that challenge in terms of why we are trying as a government to drive and increase economic growth is to increase that proportion of more New Zealanders contributing in terms of tax to fund the services in which they expect. I mean, we as a department currently collects in the region of $115 billion of revenue every year. Well, that was as of 2024, and I'm sure it's increased some. So these are significantly massive numbers. And the government is focused around increasing economic growth so that individuals across the span of our economy can contribute to that. The points that you raise, well, I think we've had those conversations on a number of occasions, and there is points that we do not agree on in the context of the underlying propensity around that. But in terms of the fact that actually, we need to tax, what we really need to do is increase the economic growth number, because tax applies if the economic growth number is bigger and the taxable income number is bigger, then the tax take will be bigger. And it's a simple calculation. Actually, the degree of tax take is greater than the degree of economic growth. So actually there is a fundamental point that if the economy grows by, say, 1%, the broader tax revenue off the back of that 1% economic growth grows at a higher propensity. And that's just because of the way in which our tax system is. There is a massive incentive for us to increase economic growth to be able to drive additional revenue to fund capital and operational spending.
Do you disagree with the findings and the extensive research and commentary from the IMF and the OECD as recently as last week? One of our major issues with regard to productivity is actually driven by the tax distortions that we currently have in play.
Look, I don't agree with everything that those entities publish, but what I do agree with is that New Zealand does have challenges in the context of a productivity problem, and this government has recognised that, and we are taking steps through, for example, investment boost to target that investment and capital expenditure to ensure that we have more economic growth that can deal with some of the underlying productivity challenges.
Does our tax
I believe we have a fair tax system in New Zealand. Can it be improved and more efficient? Yes, I think that is always the case. But one of the advantages that we have over any other country in the world is we have a highly efficient tax system. It is simplistic, and simplicity is cheaper than complexity.
Does our tax system disproportionately incentivize investment in real estate, yes or no?
I don't believe that it does. I believe that a way in which our tax system is established in the context of investment and assets, those decisions are made by individuals, are not made by government. The mechanisms in which we apply are consistent. We have a bright line test in play that deals with individuals that are in the business of property speculation.
Hang on, just let the minister finish.
Which is in effect an area that you're referring to. So we have a bright line mechanism that deals with that. If you're in the business of trading shares or even on Sharesies, you're going to be subject to that. So you're not sneaking away and making gains on those without paying tax. So I think in a main, we've got an efficient system, and we're trying to continue to look at how we make it more efficient.
Okay, thank you, Chloe Scorborough. Now we're going to go to Back to the Future with Catherine Wedd from Tuki Tuki. Welcome back to FEC, Catherine.
Oh, thank you, Chair, and thank you, Minister. Look, I'm interested in the economic growth that you talk about, and obviously we've already touched on investment booster at the field days last week. That was certainly a very popular policy, which obviously is seeing a lot more investment, which is going to grow the economy. But what else is the government doing, and you as a minister, to make New Zealand an attractive place to invest? Because obviously we're in a competitive global market. We're wanting to attract those dollars to our shores here. What are you doing as a government to do that?
Yeah, thank you. I mean, obviously in the context of driving economic growth, there's a number of levers at play across multiple portfolios and multiple ministers. It really requires a concerted effort across all of government to drive economic growth. The responsibility as Minister of Revenue is to identify policy interventions within that sphere of the broader system that can enable that economic growth to occur in the most efficient manner. Work that's underway as part of the tax and social policy work program include a range of tax changes that we have either already announced, currently in legislation, or are currently worked on. A couple of those, for example, is in regards to the foreign income regime, which we are looking at making changes on in order to further reduce the burden on particular taxpayers in terms of coming to New Zealand and being able to invest here. We've made other areas and changes in regards to thin capitalisation, which in the context of funding of infrastructure is another mechanism in which will drive and support economic growth. Obviously, and we all forget, we must reflect actually the changes that we made around reducing personal income tax rates, which seems a long time ago in the context of 18 months, but is pretty fundamental in terms of an all-of-government response to provide a significant benefit back to New Zealanders. I think this coalition government has, in the context of budget 2025 and budget 2024, actually had quite a high proportion of tax policy interventions as part of that budget. And I think what that signals is that this is a government that across the board are focused on a sensible tax policy that derives outcomes and executing that in a way which drives economic growth. And I think we're setting ourselves up for success. Those remedial changes that I referred to in my opening comments, they may not seem material in the context of that for those tax gurus and people. Just think about it as barnacles on the boat, friction in the pipe. Each one of those that we take off takes out a bit of friction and a bit of a blockage in the pipe. It makes it more efficient. It makes the system more efficient. And it's not through necessarily one big silver bullet that's going to derive this, but multiple small changes that are targeted to remove compliance costs on taxpayers will in its totality derive a greater opportunity for that money to be redeployed into creating value in our economy. And I think we are attacking all fronts on that basis. And again, the team at IRD are doing a sterling job in terms of just relentlessly focusing on that. I think I have the opportunity to go out and visit, the teams on the ground. I know a number of people around the table in their prior roles would have done the same. And I tell you what, it is hugely gratifying to go out on the ground and visit our teams from IRD and just get them to outline the work that they have been doing. What is really, really clear is that staff on the ground within this department understand that they're on the broader team. They're playing part of their role on the team to help bring in the revenue that funds public services that we all deserve. And I think, again, I just echo how proud I am of the team at IRD for the work that they do and the actions that they come. And I think as a government, all governments, the more that we can do to support them, the better we will be going forward.
Okay.
Thank you.
That's it. Okay, we're going to go over to the Honourable Barbara Edmonds.
Thank you. Minister, can you advise what
is the underspend for family boosts for the 24-25 year, please?
I don't have the number exactly as at this point, but my colleagues
Sure, I
will.
do either.
I can give you that.
James?
Between 1 to 2 million, but won't be 5 months till that month.
Sorry, can you come up to?
You mean the operating underspend
Yeah, the non-departmental.
of the non-departmental? Is Nick? Non-departmental.
Nice to see you, Nick, by the way.
Honourable
back
Barbara
to us,
Edmonds,
yep.
we will come back to you on that
So-
point.
I estimate that the underspend is around $80 million from the appropriation, and that's after the 40 million transfer from 24-25 to 25-26. How much of the underspend, whether my calculations 80 million, whatever your underspend is, that you'll come back to us, how much of that underspend will actually be transferred to the next financial year?
I think in the context of what the Minister of Finance has outlined and in the context of the intent to achieve the outcomes of the Family Boost policy, we are currently considering policy changes in order to ensure that the amount of money that is allocated as part of this policy is consistent with what we have promised to do in that regard, acknowledging we are, and we have obviously data now to reflect the uptake versus what that was estimated at. In terms of what the gap is the gap, and the policy interventions and changes that we'll make will look to close that gap. And so that's work that's currently underway but hasn't been finally agreed by Cabinet quite yet.
And maybe just a more generalised question, for a non-departmental underspend, what is the usual treatment of that? That might be from the officials.
If I can recall correctly, it would normally go back to the centre. Again, I think the question that the Minister's referring to is there was a set of policy decisions taken by Cabinet around the objectives of Family Boost.
Yes.
And so what we're currently doing is working with the Minister of Finance, the Minister of Revenue on what are some of the alternatives that would achieve the same outcome, which is a certain amount of financial support back into families. Yeah. So we're still working that through.
So the Minister of Finance a number of times in Parliament during parliamentary questions, as well as in the media, has said that the underspend of Family Boost will be ring-fenced. However, your response to question 32 of the additional pre-hearing estimates questionnaire, and I quote, "No underspend for the 24-25 year of the non-departmental Family Boost appropriation or departmental funding has been ring-fenced," unquote.
Yeah, so I think what there is I might have to get some expert opinion here. There is a technical question about how we're going to physically move the money across.
Yes, so it's not in supplementary estimates.
So the intention is that there will be the money there. I just can't remember the technical manner in which that's happening.
So technically, it hasn't been ring-fenced because decisions are yet to be made.
Yeah.
So the Minister of Finance is actually wrong.
No, I think the Minister of Finance was probably referring to the concept of ring fencing. So is the intention that funding will be used for the purpose for which it was appropriated? Yes, there may well be a timing issue, and we're still working through how technically that will work.
So look forward to your response around non-departmental funding and what happens to it if it's an underspend. That's all.
Just supplementary on that.
Yep.
Just a question for the Minister. Has the Minister had any discussions with the Minister of Finance around carrying forward that underspend? Has he had conversations?
So the conversations in which I've had with the Minister of Finance relate to the policy design of Family Boost in order to achieve the government's priorities and outcomes in which it's articulated and it intends to deliver. Those are the components of which are within the guise of my responsibility and accountability, because my department, in effect, has the policy design around that policy intervention. In the context of the way in which the funding flows, in the context of timing difference or not, I mean, at the end of the day, the government have been clear that we want that funding to reach families that have children within childcare, to support them with their childcare costs. That is an important activation on behalf of government to support hardworking families. Childcare costs is a significant component of those budgets. And, the reality is that I remain of the view that this is a very good policy that supports hardworking New Zealand families to pay for costs, which is a major driver of some of the challenges that they faced as a result of the cost of living crisis that we inherited.
Sorry, just to clarify,
we'll get
it may be late in the day, but Treasury told us to ask the Minister of Revenue in terms of the underspend because it sits with them. It's just really simple. Have you begun conversations with the Minister of Finance about bringing forward that underspend for distribution to families? It's really simple. Yes or no. Understand you've talked about the policy, but just want to know what conversations, if any. If you haven't had those conversations, that's an answer. But what conversations have been had about that underspend?
So there's a range of conversations that are continually ongoing between the Minister of Finance and I. Primarily at this point, we're looking at the policy design considerations of Family Boost to meet the government intent around the policy, which I've already outlined.
Well, it's not.
Okay, we'll go supplementary to Chloe Swartz.
Yeah, and this actually follows on from Scrutiny of last Scrutiny week, whereby we made it clear through question and answers that the intention of the policy design was for refund for partial expenses for childcare costs. But I just want to be crystal clear that is it still the case that IRD and you yourself have not asked officials to track whether early childhood education centres are increasing their costs to parents, effectively filling the gap?
Look, the accountability and responsibility of IRD is to implement the government policy around Family Boost to ensure that the criteria in which has been set for families to be eligible for the payment is met and that the payments are made accordingly. The corresponding implications in regards to broader aspects of the policy that are outside of the scope of the department are not my accountability.
Yeah, so you're not tracking the real world economic effects. Thank you.
Okay, we're going to go to Miles Anderson.
Yeah. Good afternoon, Minister, officials. I was wanting to know what IR is doing about companies that aren't paying tax but continue to trade, and those companies that are phoenixing as well that have been as an issue in the last year or two.
Yeah, I'll just provide a high-level overview and then we'll get one of the team just to give you some specific detail. But I think it'd be fair to say, and a number of you on the table will be aware of public examples in the media of companies that have gone into liquidation and bankruptcy with quite significant outstanding tax obligations to IRD. And obviously, the reality is of a liquidated business is that actually, there is a number of hardworking New Zealanders that are also out of pocket, including suppliers, as a result of those businesses moving into liquidation. But the degree of outstanding debt is obviously not where we would ideally want to be in the context of prevention is better than cure. But when a business goes into liquidation, then it's going to be even harder to recover that than in a business that's operating fundamentally. So I think what IRD do very well is that it goes back to that principle of doing everything one can to avoid one getting into a situation where they're there in the first place. But as and when, and through the data analytics and capability of the department and the early flagging within the systems, being able to get onto those situations as early as possible and to start to put in place interventions and mechanisms to get them back on track and mitigate the position of them getting to, I guess, what would you refer to as a worst case scenario, which is liquidation and they're out of business, is that. But also the reality is that, in the nature of business, some businesses succeed and some fail. And it is not the role of government to determine who succeeds and fail, obviously. But the role of IRD is to be consistent in the way in which they enforce compliance and, alongside other creditors, including banks and other entities, they do play their role in ensuring that, the money that is owed to the New Zealand taxpayer is recovered in the most efficient mechanism. And I think that's the balancing act. It's never one size fits all. Every case is different. But, what I've been very proud of seeing when I've met with the teams that are leading some of this work, whether it's small business, medium business, or a multinational phase, is that, there is a real focus that actually, what can we do as a department to avoid people getting to that worst case scenario. And I think, to be honest, that's the cheapest mechanism out of any of the options available. And it is the first tool or mechanism that one pulls off the shelf before resorting to sort of the atomic option, which is sometimes necessary, but it's definitely not the first thing that one would do. But Peter,
that's definitely where we would start, is we try and work with the firms to set up a repayment plan. If they're fundamentally viable, we want them to continue because that's consistent with what the Act requires us to do, which is to maximise revenue over time. Inevitably, at this time of the cycle, we are seeing an increase in firms that have struggled to the point where they are no longer viable. In the first 3 quarters of this year, we put 479 of those businesses into liquidation. That compared to about 350 for the whole of the year before. So that does reflect a combination of the tricky period through COVID, where we weren't being as active in the space because there was too much noise in the economy to work out whether someone was truly viable or not, plus then the period we've had since then. I think the other thing, you referred to Phoenix companies, and that is an issue. We are currently working on an information sharing agreement via MB with the Companies Office that will help us to identify where Phoenix companies are being established as a way, essentially, of avoiding their obligations.
could we just, for those watching at home, maybe my sons might want to know, Peter, what is a Phoenixing company? Just clarify that.
It's essentially a company that gets established, assets get transferred into it before there is an opportunity to close down or to get hold of the assets of the company that is in strife. And then often it's the same director who will go off and run those assets. And just as an aside, there was a court case very recently where an individual attempted to do that by moving a house, for example, into his wife's name. That information was available to us. We were able to present that to the court, and the court was able to see through that transaction. So that's the sort of thing that the additional information gives us, and it will be presented to the courts when necessary.
So not every director rises from the ashes under a new model.
Very good. Okay.
Very good.
Puns today, mate.
There we go. And I think you win the analogy of the week too by taking the barnacles off the boat. That's a good one. Okay, Dr. Deborah Russell.
A number of things I'd like to ask about. I'll just work through them. You talked at the start, Minister, about the remedials log and being really proud to have set that up. I know we were talking about that a couple of years ago. It's good to see it there. How many of the remedials on are taxpayer friendly and how many are revenue friendly? Gets prioritised. You don't know?
I'll let the team give you, I don't have a copy of the latest remedial log. I'm sure we can find that for you, but
I'd have to come back on that.
It'd be quite good to know, but how do they get prioritised as well?
So a fair few are internally from internal questions within in-name revenue, but we do, I would say my guess would be the majority would be coming from outside, from the private sector, from CANS, corporate taxpayer group, other smaller umbrella groups that are struggling with particular provisions and let us know about it. So but I'd have to come back to you on exactly the mix.
I think one of the things that we did do by publicly publishing that list is provide a more transparency to any practitioner in the New Zealand market around what is on the list and potentially what that has. That has a twofold thing. One, it helps aid, and we have advised industry participants to provide feedback around areas that they see as priority areas. The department have gone through and stratified I guess an assessment of compliance cost and benefit of any of those changes, and some are very much in the minutiae of detail but are important for certain sectors, but maybe not so wide ranging in terms of the broader system. But the fact that it is now a publicly published list, people can see what's on there. I think also importantly what it is fostering, particularly if you can recall, is being a new internal grad in the tax space, if you've got an idea around improving the tax system, you can see if an idea is not currently being logged in order to improve the system, and therefore make that submission through to the department. So I just think it's an important aspect of the broader efficiency of the system, and the department are now empowered. As Minister, I've said, I have no limitation of how many remedial fixes I will put through in terms of legislation. It is more or less so just a constraint of how big you want the tax bill, which I know you like big tax bills.
Okay, no, Deborah, we're going to go into a quick fire session now. Deborah's insistent. So she's promised quick quick questions, and I know the minister will give relatively quick answers because he doesn't have to be here till 3:45. I know he and his officials have got many more things to be doing. Deborah.
So, Minister, FBT on double cab utes, it's been in the paper again recently. Can we, and people are seem to be confused. Is IRD or will you as Minister make it absolutely clear where they sit for, I know you've said they're work-related vehicles, the rules around work-related vehicles are clear, but clearly people don't understand it. Is there a ruling coming that makes it absolutely box?
I mean, I think in the main, actually, a lot of people do understand it. There's a small number of people that don't want to understand it, I think would be fair to say, but the context is that, private use of a vehicle is subject to fringe benefit tax. It always has been, and it continues to be so. But in the context of what IRD have released yesterday through responses to some stakeholders, I think that clarity is in place. The FBT review that we are undertaking is to remove compliance costs on taxpayers. It's currently still in consultation and policy design phase, and we're taking on board all feedback in order to inform that decision point.
Yep. It's great to see that review underway and stuff happening there. There was there's a charities discussion paper out. I appreciate some of the difficulties around that. But there's also some, I can't recall, it's an IRD opinion, I think, of some sort around incorporated societies and self-dealing, and that's caused a great deal of great deal of consternation amongst a huge number of incorporated societies. Is anything being done to clarify the treatment there?
So on that one, the issues paper that you referred to did raise that as an issue.
Yeah.
At the same time as Inland Revenue released its
That's fine.
interpretation.
Yeah.
So at the moment, ministers so we're reporting to ministers in July on where we've got to on the charities reform.
Yeah.
So as part of that reporting, we'll provide some advice on the mutual association.
That's
issue.
good news, because I'm getting a lot of people writing.
Yeah.
I keep on saying, well, I think it's a process, but it'd be good to be able to say, actually, there is something going on.
Yeah.
Looking at just going through the actual vote revenue, which is, of course, an interesting thing to do. I note that our Policy Advice Division has a slight increase in its funding, but maybe not enough. How do you feel about that, Dave? Okay.
I think that's the 600,000 we got
Yeah.
for. What that's for is to measure the indirect effects of compliance. So basically what that is if we audit somebody, what impact does that have on other people that haven't been audited in the same field?
Nice.
So that's what that's for.
Yeah. Okay. Cool. On page 301, vote revenue, we've got departmental capital expenditure, and there's sitting in there 33,700,000 on intangibles.
Is it on page 320 or 321?
301, sorry, page 301.
Oh, I thought I was on the other
301.
page.
And it's
Okay, these could be good written.
there's-
You asked, what's the question?
We'll come back to you on that, not sure.
That'd be great.
What is
Intangible.
Anything else, Deborah?
Oh, yeah,
The number of intangible items.
It's quick fire.
Dr.
Yep.
Dewar.
I told you.
We're trying to keep it moving.
I read the
In accordance with
document.
accounting
I know,
standards.
you're doing very well.
So I did my job. Page 321, we're looking at tax payments made on time and the percentage of tax payments made by customers on time. In 2024-25, the standard was 90%. You were going to aim 90%. You achieved 88%. Pretty good. And budget 2025-26, the standard of percentage of tax payments made by customers on time is 84%.
Yeah.
And that's related to a change in timing, but I couldn't quite follow it through.
Okay, so there's been a change in the way we capture when something is overdue. So overdue debt, for operational reasons, we capture overdue debt once it's 25 days after the due date. From accounting perspective, we are now going to count it from when it is due. Similarly, when it comes to that particular measure, we were measuring it 7 days after its due date. We are now going to measure it at the due date. So that change in reporting measure is equivalent. It's simply that we've changed the definition of when it becomes overdue to being the day after it was due.
Are you able, Right, you've got to report against what you report against. So
We do have we will have a history, comparative, so we can go back against that measure over history.
One more, Deborah, one more.
Okay, and the last one is around the change to abatement thresholds for working for families, which was, when we're talking about a budget where in a government that's been talked about being laser focused on the cost of living.
Mhm.
And this was tasked as cost of living relief, and it's about $7 or $8 a week, which is just how the way it works with abatement thresholds. But it doesn't come in until 1 April next year. Was any consideration given to trying to get that change through earlier? So say from 1 October this year.
Look, the consideration in regards to where we set the threshold and the rate at which we abate were two factors as part of the broader policy design. The timing aspect in the context of where we've landed is what we felt was appropriate and practical in the context of getting that benefit to who needed it most. So, we are comfortable in terms of where that landed.
But it's 1 April next year, and we could get other tax relief through pretty quickly, like obviously I understand the reasons for doing the partial expense.
I can let
right
the
from budget
department
date
give
and
you an overview in terms of the complexity of system change, but
So the key difference with investment boost, because people, it applies from 22
May. It's
May,
based on budget date. I get it. Yeah.
but people don't claim it until their tax return.
Yeah.
So they've got,
Yeah.
it was a long period between when it applied and when people need to claim it. So that's why you could do that quite quickly. When it comes to working for families, because that would happen on the next time someone was paid, and the assessments are done in February. So it's with things like that, it's much easier to do it from the beginning of an income tax year because it happens in real time.
Yeah, because the payment, we would actually have to design a completely separate system to go back and do a calculation, because it's normally based on an annual income. We would have to do a separate, redo a whole bunch of calculations for that earlier period. It's actually quite a lot of additional work.
All right. So the reason that it can't be delivered earlier is
the
simply
complexity of
the administrative costs for
Yes,
inland revenue.
correct.
Okay.
It's quite a
Thank you,
big system
Dr.
change.
Russell. The last word goes to Jamie Arbuckle. He's promised me it's going to be a short vote of thanks.
Go.
Minister, KiwiSaver,
Thank you. Well,
KiwiSaver changes. You've made some positive changes there, bringing in 16 and 17-year-olds. How come? What positives can you see from that? And in the future, will we see more people enrolled in KiwiSaver?
well, the big positive for anyone that's got 16 or 70-year-olds at home or on the way, or those that they know is that those young people are working in part of the workforce, but until this change, we're not eligible in order to get an employer contribution in regards to KiwiSaver to get them on their way to saving for their retirement or saving for their first home, and or both. And I think what we did here loud and clear from a lot of feedback is that it reflects about 80,000 young people who are 16 and 17-year-old, and whether you know those that work at the local supermarket or whatever, I think this is just context of a government recognising that, if you work, you should be eligible for KiwiSaver, and that's not about your age in that context. And I think as a result, it's a real positive change, and good on those young people who are out there, actually thinking about their retirement. I'm sure all of you were thinking about your retirement at the age of 16, but it's a meaningful change, and I think a well thought out change to target that really, really important group, our future leaders and our future taxpayers.
okay. Thank you. We'll leave it at that. You started early and you're finishing early, and so we appreciate the interaction. We thank you to your senior officials and executive team. Thank you, Minister, for your time, and enjoy the rest of your day.
Thank you very much,
Thank you.
committee. Appreciate your question.